Are you a UK landlord? Well, listen to this. You could be overpaying on your taxes by hundreds, maybe even thousands of pounds every single year and not even know it. Getting your rental income tax right is, let's be honest, absolutely crucial, but it can feel like you're trying to navigate a maze blindfolded. That's exactly why the experts at ProTax Accountant have put together this guide for the 2025/26 tax year. We're here to help you stay compliant, save some serious money, and really grow your portfolio with confidence.
Okay, let's dive right in. Here's our roadmap for today. First, we'll cover the absolute essentials, the stuff every landlord has to know. Then, we'll get into the good part, claiming expenses to legally shrink your tax bill. After that, we'll level up with some advanced strategies, look at how to dodge those costly mistakes, and then we'll wrap up with a quick Q&A and show you where to get expert help.
Right. First things first, we've got to build a solid foundation. These are the non-negotiable rules from HMRC. Getting these right from the start is the key to avoiding a whole lot of trouble down the line.
So the biggest question right off the bat is, do you even need to report anything? Well, this slide makes it super simple. If your gross rental income, and I mean the total amount before you take off any expenses, is £1,000 or less, you're all good. You're covered by the property allowance. If you're in that middle zone between $1,000 and $2,500, you have to let HMRC know. But if you make over £2,500, you absolutely must file a self-assessment tax return. It's that simple, but you gotta know where you stand.
Now, this is something that trips up so many landlords. You see these tax bands, right? The crucial thing to get your head around is that your rental profit gets stacked right on top of any other income you have, like your salary. So let's say your day job already has you earning close to that £50,000 mark. Well, pretty much all of your rental profit could start getting taxed at that higher 40% rate. Understanding this is, well, it's fundamental to any kind of smart tax planning.
And here's a pro tip for you, and this one could save you a penalty right out of the gate. If you know you need to file a tax return, you have to register with HMRC. This is such a common trap for new landlords. The deadline is the 5th of October after the tax year finishes. Miss it, and you're already facing penalties. Seriously, take a second and put that date in your calendar right now. Okay, now for the part I think you're really gonna like. That's not all. Here's where most people go wrong, but it's also where you have the biggest opportunity to save money, legally. We're talking about allowable expenses. This is how you shrink your taxable profit and, ultimately, the tax bill you have to pay. Let's get into it. So here are some of the most common things you can deduct. You've got your professional fees, of course, like letting agents and accountants. But don't forget the day-to-day stuff. We're talking repairs, like fixing a leaky pipe or a quick repaint between tenants, your landlord insurance, any utility bills you happen to cover, even things like advertising for new tenants or the business part of your phone bill. The golden rule from HMRC is that the expense has to be wholly and exclusively for the purpose of renting out the property.
Stay with me, this next point might really surprise you, especially if you're a higher rate taxpayer. The rules around mortgage interest have completely changed. It used to be you could deduct your entire mortgage interest from your rental income, a massive benefit if you were paying 40% tax. But now, things are different. Everyone, regardless of their tax rate, gets a flat 20% tax credit instead.
And this slide breaks down exactly what that means in real money. Let's imagine a landlord. We'll call him Ben. He pays £6,000 in mortgage interest over the year. With the new rules, he gets a tax credit of 20% of that amount. So as you can see, that's a direct £1,200 reduction off his final tax bill. The key thing here is that it doesn't matter if Ben is a basic or a higher rate taxpayer. The credit is exactly the same. This is such a crucial calculation to figure out your property's real profit.
And did you know about this one? It's a fantastic relief that so many landlords miss. It's called Replacement of Domestic Items Relief. So, let's say the fridge in your rental property finally gives up. If you replace it with a similar, like-for-like model, you can deduct the entire cost. So if our landlord, Emma, buys a new fridge for £450, she can knock that full amount off her rental profit before tax. Just remember, it's for replacements, not the first time you buy something, and it can't be a massive upgrade.
Okay, we've got the basics down. Now, let's move to the next level. If you're not just looking to maintain your portfolio but really grow it, these advanced strategies are absolutely essential for maximizing what you get back.
And that leads us to one of the biggest strategic questions for any serious landlord today. Should you hold your properties in your personal name, or should you set up a limited company, what's often called a special purpose vehicle, or SPV? Honestly, the answer to this can have a huge impact on your tax bill.
Now, what's really interesting about this slide is the direct comparison. Just look at the middle row. It's an absolute game changer.
A limited company can deduct 100% of its mortgage interest as a business expense before tax. Compare that to the 20% credit for an individual. It's a massive difference. On top of that, profits inside the company are hit with lower corporation tax rates, not your personal income tax. The catch? More admin, but the savings can be well worth it. And as the team at ProTax Accountant always says, for landlords who are reinvesting their profits, an SPV really can be a game changer. Let's take David. He's a higher rate taxpayer and he makes £30,000 in rental profit. As an individual, he'd lose 40% to tax, keeping just $18,000. But inside his company, he'd pay 19% corporation tax, leaving him with $24,300 to reinvest. That's over £6,000 more to put towards his next property every single year.
All right, now for a section that could save you a ton of stress and a lot of money. Being tax efficient is great, but avoiding those painful penalties from HMRC is just as important. Let's walk through the most common mistakes we see landlords make so you can avoid them.
Please pay close attention to these dates. Missing them is without a doubt the single most common mistake. The tax year ends April 5th. You must register for self-assessment by October 5th. If you still file by paper, your deadline is October 31st. For basically everyone else, the online filing and payment deadline is January 31st. Seriously, get these in your phone right now.
So, why are these dates so important? Well, the second you miss that January 31st deadline, you're hit with an instant automatic £100 penalty. And this is the crazy part, that applies even if you don't owe a penny in tax. You could have paid everything you owe but just forgot to file the return, and you'll still get that fine. And believe me, that £100 is just the start.
If you fail to declare your rental income and HMRC catches up with you, the penalties get very serious very fast. After a year, they can be as high as 100% of the tax you should have paid, effectively doubling your bill. The message here is simple. Don't bury your head in the sand. If you realize you've made a mistake in the past, the best thing you can do is come forward through HMRC's Let Property campaign. It can massively reduce those penalties. Okay, before we wrap things up, let's run through a couple of the questions we get asked all the time. Think of it as a quick fire round to clear up some of those common bits of confusion.
First up, this is a really common one. Do you have to pay national insurance on the money you make from rent?
And for most people, the answer is a nice, simple no. If you're a landlord alongside your main job, your rental income isn't subject to national insurance. The only time this changes is if being a landlord is your main business. If you're managing a big portfolio and that's your primary job, then HMRC might see you as self-employed, and that would mean you're liable for Class 2 national insurance.
And with how popular short-term lets have become, this next question is more relevant than ever. What about the income you get from something like Airbnb?
And the answer here is a definite yes. Any income over that £1,000 allowance is taxable, just like a normal long-term rental. But here's a great little tip. Your property might qualify as a furnished holiday let, or FHL. And if it does, that opens up a whole load of tax benefits that normal landlords don't get, like claiming for the cost of your furniture. It's for sure something to look into if you're in that market.
So, the crucial point is that while you can definitely do all of this yourself, the rules are complicated, and let's face it, getting it wrong can be really costly. But the good news is you don't have to try and navigate this tax maze on your own. Look, whether you're just starting out or you've been a landlord for years, getting expert advice is one of the smartest investments you can make. The team at ProTax Accountant is here to help you save tax, stay on the right side of HMRC, and grow your portfolio with total confidence. You can reach out for a free consultation. The best way is on WhatsApp or by phone at 079-856-89912, or just drop them an email at info@protaxaccountant.co.uk.
So, we'll leave you with one final thought. After everything we've talked about today, what's the one expense you aren't claiming right now that could save you the most money this year? Have a think about it. And before you go, if you found this guide useful, please do hit that subscribe button on the ProTax Accountant YouTube channel for more essential landlord tips. Thanks so much for watching.